Hello, my name is William Burrows. I'm the founder of the Annuity Project, and welcome to my video series all about annuities. In this video, part one, I'll be looking at the annuity basics. We'll look at what is an annuity, consider how annuities are calculated. I'll give some examples, and finally, we'll look at the advantages and disadvantages. But let me start with the famous quote from Jane Austen in Sense and Sensibility. An annuity is a very serious business. It comes over and over every year, and there's no getting rid of it. If annuities were a serious business in the 1800s, today they're an even more serious business because they're the only financial product that can guarantee to pay an income for life. So what is an annuity? Well, an annuity converts a lump sum into regular payments for life. Normally the payments are monthly. Annuities continue paying as long as you and your partner, if it's a joint life annuity, are living, but it'll stop when you or your partner die. Payments are guaranteed no matter what happens in the financial markets, and they are 100% secure. They pay your retirement income with complete peace of mind and security. The same can't be said for some of the alternatives, such as pension drawdown, where the pension is still invested and can go up and down with the stock market. And don't forget, an annuity is a pension, but not many people realise that. This diagram explains how an annuity works. So let's take £100,000. You purchase an annuity with an insurance company. The actuaries will calculate the income payable using three factors. Life expectancy. Someone 65 can live for 25 years. They'll use an interest rate, and the current yield is about 4.5%. More about that later. And there are a number of annuity options. Single life pays more, joint life annuities pay a smaller income. So for someone aged 65 in this equation, the annuity income today is about £7,000 per annum, and that's gross before tax and payable for life. A few interesting facts. Annuities date back to the Roman Empire. During that time, the idea of guaranteed income was known as an annua. I hope I pronounced that correctly. This is Latin for annual stipends. So in exchange for making a one-time payment, Roman citizens would receive lifetime payments each year from the annua. Let's look at annuities in more detail. Income payments are guaranteed for life. This video is about lifetime annuities, but there are also annuities for a fixed term called fixed term annuities or fixed term income plans. I'll be doing a separate video about those later. Because an annuity is guaranteed for life, that's fine if you live a long time, but what happens if you die soon after taking the annuity? Well, the insurance company have a number of options that guard against early death. And payments can be guaranteed for a specific period of time, for example, 5 or 10 years. Annuities can be single life or a joint life policy. With a joint life policy, when the first annuitant dies, the income continues often at a reduced rate, 50 or 2/3, for the life of the second annuity. Income can remain level or increase by a certain percentage or inflation. I give some examples of these later on. Those who smoke, take prescription medication, or have a serious illness can qualify for an enhanced annuities. Enhanced annuities pay more income to reflect reduced life expectancies. Most annuities in the UK are purchased from pensions, and they're called pensions annuities, obviously. Or you can also arrange an annuity from your personal savings, which is called a purchase life annuity. Pension income is taxable, but purchase life annuities are mainly tax-free. So let's drill down a little bit more into the way annuities are calculated. As I mentioned, there are three factors: age and health. The older the annuitant, the higher the annuity payments to reflect the shorter period of time the annuity is paid. A number of annuity options, single or joint, level or increasing. There are income guaranteed periods or value protection. I'll be doing another video which will explain the options in more detail. And finally, the actuaries will calculate annuity rates using an interest rate factor, and that references the current bond yields. But I'll be talking more about that a little bit later when I show you a chart. So let's look at age. This is a chart from the Office of National Statistics showing the life expectancy for a 65-year-old. And as you can see, the life expectancy can range from 20 to 25 years. The thing with annuities and retirement, most people, and certainly at the beginning of their retirement journey, they underestimate their life expectancy. And it's important to remember that when you retire, depending on your age, you could well have 20, 25, even 30, 35 years ahead of you, and that's a long time. So let's look at annuities and interest rates. This chart is showing three things. The blue bars in the background is the income from a £100,000 annuity. Look at the left-hand axis. The red line is showing the 15-year gilt, and the green line is the Bank of England interest rate. The first thing to notice is that annuity rates and bond yields, gilt yields, and interest rates all travel in the same direction. If we look back to 2008, just before the credit crunch, for £100,000, you could get nearly £6,500 from an annuity. And at that time, interest rates were about 5% and gilt yields were about 5%. And we're looking on the right-hand axis for that. And then you can see that interest rates dropped like a stone, so did gilt yields, and annuity rates continually fell in this period. And if we look here, annuity rates fell continually. They fell pension freedoms. In fact, one of the reasons for pension freedoms was the fall in annuity rates. And annuity rates reached their lowest level round about the time of the EU referendum, the Brexit referendum in 2016. And they fell even further here. But remember here, Liz Truss's infamous mini budget, gilt yields spiked up, interest rates jumped up, annuity rates, and the annuity income now is back to the levels they were just before the credit crunch. And this is a good time to buy an annuity. And the question that I'm most often asked is, what's going to happen to annuity rates going forward? The short answer is it all depends what happens with interest rates and bond yields, but it's probably safe to bet that interest rates will be falling slightly, so we can expect annuity rates probably to start falling, but at a very slow rate. But the point is, annuities now at probably the top of the market, but they're still a very good way of converting capital into income. So let's have a look at some annuity examples. These rates are taken from my website. This is a £100,000 annuity, joint life, 66%. This means that if the first annuitant dies first, the income will continue to the second annuity at 2/3 of the original. It's guaranteed for 5 years and the payments are level. And look at the middle column, somebody aged 65 and the partner of 60, they can get £6,600 per annum for a level annuity. The next slide looks at the inflation-linked annuity, whereas before we had 6,600, here we've got 4,200. Yeah, that's a 30-40% fall in income. but this annuity will increase each year in line with inflation. Don't forget, inflation's like sin. Every government denounces it, but they all practice it. I'll round off by looking at the advantages and disadvantages. The advantages of an annuity are income for life, no matter how long that is. Income can continue to a spouse or partner. Income is guaranteed and there's peace of mind and security. Annuities maximize lifetime income in a way that no other product can. The disadvantages are the flip side of those advantages. Payments stop on death. The pension pot cannot be inherited. Annuities do have option, which means that income can continue to the family, and there's a value protection option. Annuities cannot be changed once they're set up, so there's no flexibility if circumstances change, and inflation proofing is expensive. Now, I maintain that the advantages outweigh the disadvantages, and it's important to remember that annuities are still the only financial product that can pay a high level of guaranteed income for life with absolutely no risk. So, if annuities are so good, why don't more people purchase them? This is the so-called annuity paradox. The main reason people don't like arranging annuities is the thought that if they die early, income payments stop and there's nothing left to leave to their family. But I think you can turn that on its head and say that for a lot of people, the priority is to make sure that they have enough income for the rest of their life. An annuity ensures that you don't outlive your income. In conclusion, annuities convert a lump sum, normally a pension pot, into income for life. Income is guaranteed for life and provides peace of mind and security. Most annuities are arranged from personal or company money purchase pension pots, and annuities maximise lifetime income with peace of mind and security. So I'll finish with a quote from Voltaire. I advise you to go on living solely to enrage those who are paying your annuities. Something the annuity providers don't want to hear. So thank you for listening. Be sure to watch out for the other videos in this series. I'll be looking at how annuities work, look at the annuity options in more detail. I'll look at annuities and pensions and pension freedoms. I'll compare annuities to drawdown. I'll dispel some of the annuity myths, and I'll look at purchase life annuities. And I remind myself to look also at fixed term income plans. So that's it. Thank you for listening. If you have any questions, please send me an email, and do visit the website www.annuityproject.co.uk. Thank you and goodbye.